Hello, everyone. Welcome to another edition of our More Than Market series. My name is Shalon Williams, Director of Investment Management Services here at NEI Investments. So today I'll discuss our policy rate expectations for the Bank of Canada and the US Federal Reserve as central banks continue to tighten monetary policy in order to contain inflation, which is now at decade high levels. As you may remember, on April 13th, the Bank of Canada increased its policy rate by 50 basis points to 1% and began its quantitative tightening on April 25th. And maybe just a quick explanation as to, or a reminder as to what quantitative tightening is, or QT, as it's popularly called. So quantitative tightening is another part of the central bank's toolkit where the bank will allow the bonds that mature to naturally roll off its balance sheet instead of replacing those bonds. So essentially, the intention here is to reduce the size of the bank's balance sheet over time. So fast forward to this week, we're expecting that the Bank of Canada will increase its policy rate by another 50 basis points at its scheduled meeting on Wednesday, June 1st. So that should bring the overnight rate to 1.5%. Our view of a double hike is consistent with market pricing. The market has been expecting this for a while now. It's already priced in, it's already baked in the overnight market. So we don't really anticipate much movement in the bond market or even the equities market following Wednesday's decision. In terms of the BoC statement this week, we expect really limited guidance. We will have to wait until the publication of the next monetary policy report on July 13th in order to get forward guidance on the outlook for inflation and the economy. I think at this point, the real wild card is, how far above 2% will the terminal rate be? In terms of looking ahead, we expect another or further 50 basis point rate hike in July as well. So that should take us to 2%. And then after that, we expect that the BoC will possibly slow the pace depending on how economic data looks after that. So essentially, we're expecting that these rate hikes will be front loaded. And I think that way it gives the BoC greater optionality or room to pause or reduce the pace of hikes depending on how economic data looks at that point. And if you think about the Canadian economy, it's a very interest rate sensitive one, given our housing market. So the economy may be a bit more responsive to these rate hikes relative to the US economy. We're already seeing where financial conditions have been tightening. Mortgage rates have increased notably prior to these hikes, which will likely accompany a slowing in the Canadian housing market and taking some of that excess froth or that excess heat off of the housing market. So maybe just to sum up once more, again, for the BoC, we expect 2 double hikes, one this Wednesday and the next in July. And after that, it's likely that we will see a slowdown in the pace of hikes leading into September. In terms of the US Central Bank, we're expecting similar moves as the BoC. So we're expecting a double hike in June and July. And these moves have largely been confirmed by a number of Fed officials. We're already seeing tightening of financial conditions and some amounts of soft data coming out of the US. We're seeing signs that the housing market again could be cooling in the US. Sales of newly built homes dropped 16.6% in April. Also, the number of home sellers lowering asking prices reached its highest level since October 2019. So definitely some tightening of conditions there in the US, some slowing of the housing markets. And then as it relates to PMIs, the S&P Global Flash US Manufacturing Purchasing Managers Index, or PMIs for short, fell to 57.5 in May of 2022 of this year from 59.2. So that has been the slowest pace of growth in the last 3 months. So we think central banks, both the BoC the US Central Bank will be really keen at looking at economic data as it tightens policy. So as these conditions tighten and as economic growth slows, that should help to naturally moderate the level of inflation. And if that happens, then central banks will likely become a little bit less aggressive in terms of increasing interest rates. So with that, I'll stop here and say thank you for tuning in. Hope you found today's discussion very helpful. Watch out for our next More Than Markets series. And as always, reach out to your NEI representative with any questions that you may have. Thank you and stay safe. Bye for now.